I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our latest Following the Money podcast. Today is October 9th, 2023. Today I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Now let's follow the money. First, let's look at U.S. interest rates. They have really, in our view, been the driver of certainly the stock market for some time now. For about the past 2 months, most notably in my August 23rd interview by Oliver Rennick of the Schwab Network, which was formerly the TD Ameritrade Network, I have been warning that a rise above 4.3% in the yield of the benchmark 10-year Treasury note would likely trigger a sharp decline in the U.S. stock market. These yields rose and remained above 4.3% on September 19th, and the benchmark S&P 500 has since declined by 5.3%. You can view that August 23rd interview directly from the Schwab Network or by visiting asburyresearch.com and clicking the media tab across the top of the screen. More on U.S. interest rates. There are two important yield levels to be aware of in the 10-year yields this quarter. 5% and 5.34%. Both are up above the market. The yield of the 10-year is currently hovering right around 4.80. 5% is a big round number that the markets love to trade around, whether it's in equities or in fixed income, and 5.34% represents the July 2006 and June 2007 benchmark high yields. The market has a memory and does not forget these key levels. Remember that when the 10-year yield tested 4.3% in October of 2022, and when yields sharply retracted from there and moved back underneath 4%, that was the launching pad for the October 2022 bull market in the S&P 500. Now let's move to the stock market. The benchmark S&P 500 will begin this week situated just above major support at 4,200. It's actually moving down closer to there now due to the emerging war in the Middle East. As long as the support holds, the larger October 2022 major uptrend in the index will remain intact. Historically, based on data since 1957, November and December are the first and third strongest months of the entire year in the S&P 500. However, if S&P 500 4,200 major support is broken to the downside, it will warn that a major bearish trend change strong enough to overwhelm 65 years of seasonal tendencies is starting to emerge. Here's an important side note. Major inflection points like SPX 4200 don't come along every day. In our view, identifying these key levels in advance and correctly determining which indicators to pay attention to identify the next strategic move away from those levels as soon as possible are the key moments of your trading year that can greatly affect the outcome at the end of the year and sometimes longer than that. Let me take 30 seconds of your time for a brief commercial before we get back to the latest markets info. On Saturday morning, October the 21st, I will be presenting an hour-long educational webinar via Zoom entitled Trade and Invest Better with Less Risk by Following the Money. This webinar is not meant for current Asbury Research subscribers, as they are already getting all this data from us, as well as the latest changes to our data-driven models. But for those of you that are listening to these podcasts and like our approach to markets, this should at the very least be a good learning experience and is likely to provide some good data-driven ideas on how to best navigate the fourth quarter in the U.S. financial markets. Let's move to market sectors. Our CEF model has exited its July 31st overweight in the energy sector. It actually exited on October the 4th, capturing 6% of relative outperformance versus the S&P 500 during that 2-month period. Heading into this week, technology and communication services are the two best rated sectors according to the CEF model. Asbury Research subscribers can get more specific details on our CEF model's latest signals by visiting the Research Center. The CEF model outperformed the S&P 500 by 4.5% during the third quarter of this year and has now outperformed the S&P by 10 of the past 13 quarters. You can visit the latest You can view the latest Q3 CEF model performance data in more detail by going to asburyresearch.com clicking on models across the top of the page, and then scrolling down to the CEIF model. We have also recently launched a new model, CPM Plus, which is a newer version of our CPM, or the correction protection model. This model, as well as CPM before it, the legacy model, were developed for older, more risk-averse investors that want to or need to participate in the stock market but can't afford to take a large drawdown. You can learn more about CPM Plus by visiting asburyresearch.com, choosing models again across the top of the page, and scrolling down to the correction protection model. So there it is, our latest bi-weekly Following the Money podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we move into the fall and winter months. Remember to pay particular attention to the yield of the 10-year note, to major underlying support in the S&P 500 at 4,200, and also to the stock market's historical tendency to be particularly strong during the fourth quarter, especially during November and December. We'll see you again right here in about 2 weeks with our next Follow the Money podcast. In the meantime, make sure you subscribe to Asbury Research on YouTube for more podcast and data-driven trading and investing information just like this. If you are interested in subscribing to our premium content, you can use the contact tab at asburyresearch.com to request further information, including service and pricing options. Now we close with the legal stuff. This podcast is provided for information purposes only and is not intended to be a solicitation to buy or sell securities. The performance indicated from backtesting or historical track record may not be typical of future performance. No inferences may be made, and no guarantees of profitability are being stated by Asbury Research, LLC. The risk of loss of trading of financial assets can be substantial. Therefore, you should carefully consider whether such trading is suitable for you in light of your financial condition.